Good morning, everyone. Welcome to this morning's session and this morning's workshop, which is From Surviving to Thriving, Building a Sustainable Business Strategy. Today, we're going to be looking at do's and don'ts of planning a successful succession strategy for business from the legal, personal and financial and money aspects. We will look at how to plan a strategy and support your business, partners and family. Today, I'm delighted to be joined by four fantastic speakers: Roddy Harrison, Billy Andrew, Gareth Welshman and Geoff Treshman. So the way that the format of this morning's event is going to work is we're going to hear from our four speakers, and then there will be time at the end for the Q&A. We do ask that if you have any questions throughout of the presentation to put them in the Q&A function, and these will be picked up at the end. Thank you so much for joining this morning's session as part of Edinburgh's Business Festival, which is going on all week. And thank you very much to the sponsors of this workshop, Wright Johnston Mackenzie. So without any further ado, I know we've got a lot to get through, so I'm going to pass over to Roddy Harrison from Wright Johnston Mackenzie to kick us off. So over to you, Roddy.
Thanks very much. Good morning. My name is Roddy Harrison. I am a partner at Wright Johnston Mackenzie in their private client team. The brief synopsis of what we're doing has also been already been given, so I will crack on with what we have to deliver. One thing I just would like to caveat this whole process about is that unfortunately everything today that I say is going to have to be caveated slightly, purely because I don't know what Rishi Sunak is going to say at 12:30, and so therefore all the tax advice I give may be changed in an hour. It's not often that I can sit and give an informative talk and say, by the way, I may be talking rubbish because we're about to change everything. Anyway, if we could go on to the first slide, please, that would be great, thanks. Looking at planning a business succession strategy, obviously I will be giving you the optimum advice as to what to do. However, reality quite often intrudes on these things, and you do have to be careful about that. But when is the best time to plan? Strictly, it's now. It doesn't matter what stage you're at in your business, what stage you're at in your life, because you do need to start planning and looking at what needs to be done. You never know what's going to happen and when it will come. And I'm afraid, and it's unfortunately very poignantly apt right now, but at the risk of sounding morbid, death is a when, not an if. And so we do need to plan about these things, and we do need to look at what the options are, both for emergency, but also for long-term succession. And my aim here is to look at what you can do, both from planning for a long-term succession, but also you have the break glass in case of emergency option of what's going to happen if there is an accident and you're unable to deal with things going forward. Firstly, you need to consider who you want to succeed you. Now, this is not necessarily set in stone. This is something that will change and will evolve as your business grows, as your family grows, and also as the business environment in which you work grows as well. So in all cases where I'm looking at these issues, it's a case of there are various options that you can look at and various options that you can consider. And sometimes it's one day it's going to be one thing, the next day it's going to be another, and sometimes it will be a hybrid of these. But the three most obvious ones are who is to succeed you are your family, a business sale, or your employees. I'm going to go into more detail on both employees and family later, but looking at a business sale, because I want to cover this off briefly at this stage in proceedings. This is arguably, and I do say arguably, the most straightforward option, because it means that you're just handing over control. You are selling your business. It's a market transaction. Someone else is taking it over. And with a bit of luck, you're making a decent amount of money out of it. Things you do have to consider, though, are you prepared to hand over control? Because if this is a business that you founded or run for a long time, handing over control is actually quite a difficult process to do. And what are you going to do after it? Which may seem like a very mundane question, but you do need to think about how you're going to deal with things afterward, particularly when you consider it in the context of a sale, because the options on sale usually will involve either a cash purchase or shares with an earn-out where your shares are actually being bought back gradually. You need to watch that from a tax aspect, and I'll come on to that later on in the talk. But you do need to consider how you are going to get your business out and also how you're going to get your money out of the business as well. The other thing you need to consider is the golden handcuffs option, and that's both the purchaser will look at it from a business continuity point of view. They will likely, if it's your business and it's very much tied up with your personality, they'll want you to probably stay on the business to actually continue to run it for a handover process. And also, there are likely to be restrictions on how you can operate and what you can operate in the future, so that you don't immediately set up in competition. I mean, the most obvious example around Edinburgh is the fact that we used to have Quick Fit. Quick Fit was sold by Tom Farmer to Ford, and thereafter suddenly we had, or at least after, presumably after the covenants had expired, we then had Farmers Auto Care. Going on from that to the options for succession, I've dealt with it in slightly reverse order in that we've looked at sale, but there's also inheritance or gift. You can either give it away or it can be inherited in terms of a will. And finally, there's the employee option, the employee ownership option. Now, looking at all, you can have a combination of all of these as well, and that is quite important. It isn't necessarily limited to an all or nothing, but I will consider them in isolation. Could we have the next slide, please? Looking at transferring it by inheritance or gift. If we look at it from a gift perspective, or at least passing it on to family or close contacts as a direct one, the first thing you need to consider is who do you want or is fit to succeed you? And you need to consider things like what age are they? How old are you? If you're looking at family members, how old are they? Are they fit to receive it yet? You also need to be very realistic in how you look at things. You can't actually have rose-tinted spectacles on any of this. The number of times I've sat down with clients who said, oh yes, my sons will inherit, they'll run the business together, it'll be all right. And I think as soon as you have to say the words, it'll be all right, then you actually need to seriously consider whether it will be all right, because quite often you have to think of the fact that as the founder of the business, the individual is the glue that holds things together. I spent 6 months once convincing a farmer that actually the business was not going to be all right for the simple reason that his sons hated one another, quite literally hated one another, and the business was not going to work after he'd gone. So we then had to rethink it. If the family members are not ready, then you probably need to consider the option of an interim manager. And that will probably be from your existing staff. So you need to consider who the best person it is that can take over the business. And that's important both in terms of medium to long-term succession, but also in case of an emergency as well. Because if you become incapacitated, if the owner becomes incapacitated and unable to deal with things, then you need someone to actually step up to the plate and deal with things. Going into what the gifting options are, you can either make a direct gift, which means that you give the shares, give the business to the people who are going to succeed to the business. That's just a lifetime gift. Or you can consider a lifetime trust for younger recipients. So if, for instance, it's going to go to the children, but the owner of the business doesn't actually want to continue running the business, then it's not appropriate for the children to inherit, or they're maybe even just too young and unfit to deal with it. So you then need to consider what your options are for that. Now, there's various, I'm not going to go into things like family investment companies, which are other options to actually own the business, but I'm going to look more at trusts. And a lot of people consider trusts to be quite scary things, which are only for the rich. We obviously, as lawyers, deal with them on a regular basis, and they're not, because they can be quite simple and flexible. And your best way to think of a trust is as a contractual arrangement. The assets are given to the trustees. There's a contract, which is the trust deed, which governs the relationship between the trustees and the beneficiaries. And the trustees have said, look, here's a series of assets. You are to look after these assets for these beneficiaries and ultimately transfer them to you. And the terms of the trust are what govern the relationship. And that is it in its most basic form. And you can think of that as either an ongoing thing or even just as a flexible framework to allow decisions to be made at the time. And this leads me on to the will, which is something that should be put in place right from the start, because the will is covering, as I said, the break glass in case of emergency. If someone dies, you need an appropriate will in place, because otherwise the only people who will make money out of it are the lawyers in the argument that will ultimately ensue. There's various options that can be considered in a will. Once again, you can have a trust, but a fairly common option is if you have a business where one of the family members works in the business and another family member doesn't, and the owner of the business needs to benefit them both equally, or feels they need to benefit them both equally. But the difficulty around that is that how do you reward the person who works in the business, but actually also make sure that the person who does not work in the business is able to benefit from the fruits of the business if that's the principal asset of the family. And there are options on that in terms of granting legacies of shares and granting what we call cross-option agreements, so that each beneficiary can buy the other out to avoid complicated things like minority shareholders disputes, so that one beneficiary can muck things up for the other, whether that's the one who works in the business and owns the majority of the shares or the one who doesn't work in the business. Because there are all sorts of rights granted by the Companies Act in favor of beneficiaries to allow them, or at least in favor of minority shareholders, to allow them to query the decisions of the company. So it's really important that the will deals with that structure and avoids, it doesn't necessarily avoid the dispute, but what it does is it avoids the cost of the dispute escalating into court, and the will has to be very tight in order to deal with that. Looking also going on about who the new owner and the family relationships are going to be, I touched on this briefly as to who's going to succeed, because it's not just the original owner. And that's both in relation to how the business is run, but also how the business is owned in the future. And it's important to distinguish at this point between what the difference between ownership and management. Because management is the day-to-day running of the business. That's the cogs, that's the engine that keeps the cogs grinding on and actually producing the goods and dealing with the business. But ownership is the overall function, the strategic function, looking forward as to how it's going to work. And there is a really important distinction between the two. And that's particularly important when the family starts becoming involved in the business and it wasn't the original owner, because the original owner understands how the business needs to work. But when you have disparate family members who aren't necessarily involved in the day-to-day running of the business, then there needs to be an agreement as to how hands-off they're going to be to allow management to get on with things. And that's a really important practical point. There's mechanisms to do that. As a lawyer, one tends to look at things like shareholder agreements, but it's also possible to govern those relationships in the future. And Billy will no doubt be talking about this too, in terms of family constitutions as to how that relationship is governed. Because you have to consider the option of, say, the daughter is running the business and the son is not involved in the business. And when they're talking to one another, they have to consider what role they're playing. Are they playing it as co-owners of the business, or are they talking about it as brother and sister? And that's, speak as a man with two older sisters, that's a very important distinction at times, because otherwise they let the relationship cloud how the judgment's going to work. Going on from that, you also need to consider what the tax implications are. And I'm going to touch briefly on this. Once again, the caveat about what Mr. Sunak's going to say now or in the future. If you transfer your business for no consideration directly to someone else, this is what's known as a potentially exempt transfer. You will probably have heard of the 7-year rule, that provided you've made the transfer and the individual now owns the business, then that is the 7-year rule applies. And provided you survive for 7 years after making that transfer, then there shouldn't be an issue around it and there won't be any tax. Furthermore, there are exemptions available. And the most important one for a trading business is what is known as business relief, or as it used to be known as business property relief. And if you have a trading business which is transferred, then there will be no inheritance tax provided it qualifies as a trading business. It doesn't apply to an investment business such as owning commercial buildings or owning residential property, but it does qualify. If it is a trading business which operates, then it will qualify for business relief. The advantage of this is that it's 100% exemption, and the conditions are that A, if it's a lifetime gift, it is owned and run as a trading business at the time of transfer. And when the individual dies, if they die within 7 years of making the transfer, it's also run as a business, or there is a replacement business operating at the same time. So that's really important. If an asset is transferred into a trust during lifetime, then this is a chargeable transfer for inheritance tax purposes, which means that there potentially is a charge, but once again, business relief is available. So it's a really, really important relief for people. We all do hope that this isn't going to be touched, in the immediate future, because it is a very good way of businesses to pass from one generation to another, or even from one owner to another as a gift without there being issues around it. Going on from that, you also need to consider capital gains tax, because whether you're selling or whether you are gifting the asset, then that will trigger a charge to capital gains tax. Now, capital gains tax is paid at various rates, but if you are selling a business, entrepreneurs relief should be available. Now, this started off as a very high relief and was payable only, was available for the first £10 million worth of gains. However, this was restricted considerably last year to £1 million worth of gains, because it was to cover off people who were serial entrepreneurs and only paying capital gains tax. The advantage of it is that it restricts the amount of tax payable considerably, and so therefore it does actually, it's a very useful exemption to have, provided that the individual holds 5% of the share capital and is employed in the company. Now, you'll recall I said that there are tax implications for selling the business, and particular implication is the issue of looking at how you get these hybrid sales, so you don't just sell shares, but you sell shares plus an earn-out provision. And if the individual is no longer employed in the business, or you get qualifying corporate bonds issued, then you can potentially lose the relief. So careful advice needs to be taken to ensure that you don't create problems for capital gains tax purposes by virtue of the sales structure. And so you need to ensure that you take advice on dealing with that to ensure that there isn't going to be an issue for that going forward. You also need to be careful of the interaction of taxes, because technically a gift could lead to a charge to inheritance tax and capital gains tax at the same time, but you are available, what is known as holdover relief is available, which means that the gain is held over so the trustees acquire at a lower date. So as you can see, there's quite a complex interaction of taxes between between inheritance tax and capital gains tax, and I'm not touching on income tax at this stage, but you need to consider all of these around the succession, and you need to ensure that you take proper advice to know what the obstacles are, because proper planning, incorporating the tax aspects, is very, very important. Right, could we move on to the next slide, please? Finally, we go on to employee ownership. Now, please bear in mind the point that I made earlier is that you can do a hybrid of all of these. So potentially you can have family members owning it and some of the assets, some of the shares also being employee ownership as well. It doesn't need to be the whole of the company. And potentially you can also have an employee ownership structure as well as actually selling part of the business as well, because you can put everything together. I'm considering them in isolation because I'm afraid we don't really have time to go into everything in a great deal of detail today. Obviously, for employee ownership, you can either have a gift, a sale, or a hybrid of the two, depending on how you want to work it. And once again, the tax considerations will apply as to how you deal with it. And the two options you have really are direct employee ownership, which is what it says. You transfer the shares, sell the shares to principal set of managers or even individual employees so that they each own shares in the company and they have an interest in the company going forward. That then means that you have a much more disparate group of owners, and you have to be careful to qualify how things are going to go forward, or at least how the ownership structure is going to go forward. Because obviously, if you have individual owners of businesses, they will then be able to transfer, shareholders, they will then be able to transfer their shares onto others. And it will quite often be necessary to restrict who they can transfer it to. Otherwise, you end up with too many shareholders and you dilute how the ownership and also potentially the management structure is going to be. Going on from that onto indirect employee ownership, which is much more popular, I think, and also, although it is complicated, there are many more incentives, and you'll have probably seen Scottish Enterprise have done if you look on their website, there's a number of options which you can actually look into and get more information on this. But the structure is what's known as employee ownership trust, And what this means is that the shares are actually owned by a trust for the benefit of all the employees. And once again, if we go back to what the trust was, it's a relationship between the trustees and the beneficiaries. They pay out dividends, they can potentially distribute shares. It depends on what the terms of the trust are. But it does enable the employees to get a degree of ownership, a degree of control in the business, and also a degree of buy-in as to how the business is going to work. There's a number of examples on the Scottish Enterprise website which are extremely useful to look at, because they show how there is more employee engagement and there is a greater sense of identity with a company for employees who do have a stake in the business. Now that neatly finishes off what I was going to say. Billy Andrew is now going to take over from Family Business Solutions, and he's going to look at issues facing families in dealing with succession planning. I'll hand over to you, Billy. Thank you very much.
Thank you, Roddy. Hello, everyone. I'm going to look at this for a little while on the basis of a consulting look at things rather than a technical look at things. So I would stress that in my job as a consultant to family and owner managed businesses, I'm not a lawyer and not an accountant. So the technical side, we try to leave to the professionals, but there is a need for what we call joined up advice. And if you look at the average way that people go about planning things, they sometimes find that they've got a really good piece of correct advice over here and a really good piece of correct advice over there. But when you try to get together in a bigger plan, they don't quite match up. So there is a real need here. And one of the things that we discover and have to learn again and again, every day's a school day in consulting, is that you cannot separate family and business. So if you look at the family side and the business side, and to a certain degree, this is true of non-family owner managed businesses as well, where they've built up relational based partnerships over a period of time. What we try to contend with here, and it's a rule that should never be broken, I guess, is that there's an emotional system going on alongside an economic system in family and some owner managed businesses. And that affects decision making, and it affects goals and aspirations and objectives, how things are owned, how things are managed. An illustration of that is the first slide here on performance, exit and succession, where we're trying to blend these things together. Exits have to be afforded, and succession has to be viable. Succession has to be viable in both functionality and economically. This list here on this slide are just some of the issues that can arise, and they really cross the boundaries of personal issues and family issues and business issues. And I guess that really one of the things I'd love to stress to folk is do think about it not in an overwhelming sense. That list that you're looking at there could almost be double or three times that list, and it really can be looking like mission impossible to people. But with a good plan and a way of narrowing it down, and I'll show you as we go on some of the ways we try to simplify this, because when you're consulting on this, the idea is to try and get as much of an idea of an insight to the family and the owners and the managers as to what they're looking for. But you're looking at some things there, like you could see them, you can read them for yourselves, obviously, but there's a good cross section there of business issues, family issues, wills, and things that actually affect the business. Roddy mentioned there wills and shareholders agreements and constitutions, all of which can be utilized. And it's good if they're actually talking the same language. So the real key here is to try to find out what the family want. And three questions, if you want to note down three questions, is why do you want to remain in business together if it is a succession plan? What kind of business do you want to be? And how do you plan to get organized? So go over those again with you. So why do you want to remain in business together? Will give you what we call shared purpose. It doesn't have to be, excuse the expression, like the Waltons, where everything is harmonious and perfect, but it does have to have enough shared purpose to sustain it. So the why question will give you that. What kind of business do you want to be? Do consider that from all angles and look at it from the successor's point of view as well. And how would you get organized? And Roddy also mentioned they're splitting ownership and management. These two are not always the same things. Can we move on to the next slide, please? Now, I'm not going to go over the same ground, but the reason I thought you should look at this slide from a consulting point of view, not from a technical point of view, is it's one thing to say, come and get advice. It's another thing to say, what advice do you go and look for in the first place? So there is a certain truth in the old adage, you don't know what you don't know. And between the dialogue that goes on with you and your consultants and your advisors, you can actually build up a picture. But if you look round the clock on a clock face here, then you would be looking at some of these options: share transfer to family members, share sales, appoint a caretaker manager, MBO and employee ownership trust, liquidate the business, sell the business, flotation. Now, rather than me repeat things that have already been said, one of the things that I wanted you to focus on was the last one, which was the do nothing option. Now that, believe it or not, tends to be the most popular choice in succession planning. It's also the most risky, and it also leaves you quite vulnerable. So if you're an owner of a business, then the question I probably would put to you is, what is the difference a plan makes, and how much do you want to make decisions or have decisions made for you? Roddy started off his talk by saying the best time to plan is now. I would absolutely echo that one. And if you want to make sure that the plans that will ultimately be in place are the ones that you have decided and you've considered, rather than decisions that are made for you, then now's the time to think about it. Even from a technical point of view, Roddy was mentioning there that there's inheritance tax issues and trading and exemptions and whatever. And there are a number of cases just now where people who are landowners are very successfully building trading businesses around that for the purpose of tax efficiency. And these are just things that happen, but you cannot do those overnight. So that takes planning, and it takes early cognizance of it and getting on with it. So do consider that the do nothing option is, I would say honestly, it is sadly the most common, tends to be something that people leave, but it's also the most risky. Can we move on to another slide? We're often asked in consulting and family business and owner managed business if there are frequently asked questions, and you always come back with the answer, we have a bigger problem with frequently assumed answers, right? I'm not sure what size of screen you're looking at the moment. So the text may be quite small on this one. But if we jump over across, it's divided into owners, successors, and non-family managers. And if we jump across from frequently asked questions to frequently assumed answers, you'll get a picture of what can go on. The owners will sometimes say, we can't afford to retire, not yet, not until, sometimes not ever, if their business is their pension, right? Others will say they will or they won't, the successors will or won't want it. They say their futures are better elsewhere. It'll lead to conflict. They're not up to it. The successors, on the other hand, will maybe assume things like they won't retire, or they won't really retire, or they won't hand over or sell, or they won't discuss, or we can't raise it, or we won't have the means. And interestingly enough, non-family managers are affected by this also, because they say that we can't raise issues, it's difficult to raise them, they won't agree, it's a family subject, and they won't discuss it with management. So in our work in consulting with family businesses, we often find that you have to look very seriously at these frequently assumed answers. They actually stop what needs to happen in this process, which is the initial conversation. And they do actually get in the way. So it's a case of breaking through those perceptions and opening it up a little bit. Can we just move on, please, to the next one? Now, this looks like simple headings, but if you imagine it as a journey, we call this the family business journey, the owner managed business journey. And it's a very strict sequence. It's a very simple sequence, right? Essentially, what we're basically saying here is if you have a conversation about it, you will end up with perhaps conflict. You will end up perhaps not being able to be fully transparent, but you should not be put off by those, because the conversation is essential, right? So wherever you happen to be, and if you cannot find a way to have the initial conversation about why you want to remain in business together, and what kind of business should it be, and how would you get organized in ownership and management and decision making, who's going to be involved, who's not going to be involved, who's going to be a shareholder, who's going to be a manager, who's going to be a passive shareholder. And there are all sorts of jokes, by the way, about how passive is a passive shareholder, right? I'm sure you've had those kind of discussions. But the conversation, nonetheless, is necessary. And a good part of the time, myself, my colleagues are involved in facilitating that conversation, because it's quite difficult to have, depending on the dynamics. The next thing that you want to be looking at is to have a consultation. And by that, I really mean, look at all these issues that have been discussed already this morning. Now, it's quite difficult for folk to come up with a big picture of what they would want to have. But imagine a situation where you go straight to the end of this sequence here in implementation, and you invite around to your home this afternoon 4 people, let's call it 4 people. You invite your lawyer and your accountant and your banker and your financial advisor, and maybe a management consultant, whatever, depending on the structure of your business. And you invite all those people around this afternoon to your home or your office. And you say that you've discussed this. You now have a shared purpose for ownership and management for the business. You have an exit ambition. You have a succession aspiration. And you say to these 4 or 5 people, would you please make this happen now? Make it happen in legal, accounting, banking, wealth management, and management terms. And then you have to step back from that and say, am I in a position to actually do that? Could I invite these 4 or 5 people round and give them that? And if the answer to that is no, then go back up the chain of what you see in front of you and ask yourself these 6 simple questions. Have I had the conversation, and do I need help to have it? Have I had a proper consultation? Do I understand my options? And I would give you 3 words that might help you there: planning, protection, and provision. Almost everything that comes into a consultation will fall under one of those 3 categories. Something you need to plan for, something you need to provide for, and something you need to protect. So planning, protection, and provision. And if you can have a good consultation with your advisors on those 3 things, then you can move on and say, we can form a shared purpose in ownership and management. Shared purpose is indeed the glue that holds the thing together, but I think we need to be realistic about that. It doesn't have to be harmony and perfection. It just has to be something that people buy into or out of, as the case may be. Then you've got these big choices that need to be made. The big mistake I find often that happens is that people are making these choices and decisions about ownership and management without having done the first three. And that makes these choices and decisions sometimes flawed and impaired. And sometimes, if I'm being honest, unnecessary, because they're based on perceptions of people and each other. And frankly, I don't mean to sound blunt here, but there's more energy goes into judging individuals sometimes than understanding them. So if you get the first three right, then there's a good chance that you will have a better platform for making the choices and decisions. Then you need a good way forward. This is the exciting part, when you actually plan out some simple, straightforward statement that brings it all together and says, as a family, as owners, this is what we want as an exit plan. This is what we want for successors. This is how we plan to go about it. And then down at the bottom, without repeating ourselves again, you would aim for bringing your professional advisors together under the banner of this way forward and saying, please advise me, please implement this technically so that we can achieve this goal. And if we move on to the next slide, please. This is basically what we're looking for here. 6 outcomes: certainty, clarity, prosperity, unity, peace of mind, and enjoyment. Let's look at them just individually very, very quickly. Certainty, best way I can describe that to you is to come from families. Families will always tell us that it's all based on potential and targets and balancing family needs against business needs and whatever. But there are 2 statements that stand out for us. One is, I want a clear way out, and I want a clear way forward. So when you come to actually getting to where the rubber hits the road with families and saying, what do you actually want here? What do you want to do? And can we sum this up in something very simple? They want a clear way out. It may sound very simple, but that confuses a lot of people. And sometimes they feel trapped that they don't have a clear way out, and they want a clear way forward. And the clarity, we're looking for all the things that we've been discussing so far. Who's going to own, who's going to lead, and who's going to be involved. If there's no clarity about that, it becomes a bit of a mess. And prosperity is down to income, opportunity, and wealth. So when you get a family together, and particularly successors, and you try to put a plan together that will be something that will motivate successors and that they will want to buy into, then you're looking for a good mix of income, opportunity, and wealth. It's not always about money or assets or shares, but income, opportunity, and wealth will cover it pretty much in terms of successor aspirations and getting a good balance of those. When you're looking for unity, you're either looking for perfect unity or enough to give you a consensus or a support, or enough to support choices that are actually very difficult choices and very different choices. But you have enough of understanding between you to actually make those choices. Peace of mind would be the absence of division and conflict and risk. So, 2, a large number of seniors and owners. The nightmare of exit and succession is the concept, the prospect, we'll call it, of them leaving a legacy which will bring division and conflict and possibly even financial risk. So you will not get peace of mind if you have not addressed those 3 things that trouble people. And the last one, it might look like a little bit of a luxury, but if you hear people talking about how they started a business and what it's become, it's gone from an exciting adventure to a burdensome curse. And some people have described it as an intolerable level of misery, right? Now, that's an extreme case. And I'm always anxious to point out that when you're an advisor on any subject and a consultant on any subject, how easy it is to give the impression that the clients you serve are largely dysfunctional, inoperative, and whatever. And that, as we all know it, is very, very far from the case. And I'm always anxious to point out to consultants, particularly management ones, don't ever offer to do your clients' management's jobs for them. You will seriously embarrass yourself. They are probably more adept at their business than you will ever be. So there is a need here to get this into perspective. And enjoyment means regaining the motivation and leaving potential. And if you can define your enjoyment category as regaining motivation, restoring motivation, and leaving potential, then there is a very good chance you do all of that, you will achieve these 6 things. Now, it's really, really important when you're doing exit and succession planning to have these 6 things in mind, because these are our outcomes. These are our goals. This is what we want to achieve. This is where we bring value. This is what the client wants. This is what the client needs. And as good a mix and measure as possible, we need to achieve these 6 things. And we do that by the sequence that I mentioned to you beforehand. Now, that's pretty much all I want to say at this stage, because we're maybe going to hold some things back for Q&A later on. So I think I would like to leave it there and hand over to Gareth, please. Yeah.
Billy, many thanks. My name is Gareth Welshman. I'm a private banker with Kleinwort Hambros Private Bank. I'm not a corporate banker, but I do look after a lot of business owners and make financial arrangements for them around their personal affairs. And I've also been on the journey with a lot of those people as well, from before they sell their business through the process of selling that business, and then into that post-exit world, whatever that looks like for them. I think Billy touched on a really interesting point. When you're looking at business succession, there are a lot of technical aspects to consider, the tax position to consider, but there are also a lot of emotional and often inter-family items to touch on as well. So you can come up with a great technical exit plan or succession plan, and if it doesn't take account of the family, if it doesn't take account of the emotional aspects of exiting a business, then it is far less likely to work. Next slide, please. Just to echo what pretty much everyone else has said, preparation and planning is vitally important for business succession. There's a saying about trees, which is also appropriate to businesses. So when's the best time to plant trees? The best time to plant trees was 20 years ago. The next best time is now. So it is with business succession. The best time to plan business succession was some time ago. If you didn't do that, get started now. One of the things I would urge people to do is have a think very early about what their future involvement with the business is going to be. It won't always be your choice, but when you come to exit the business, do you simply want to walk away? Do you want to keep an involvement? Do you want to be tied in? As I say, it might not always be your choice, but if you have a strong succession plan, then and if that's built around your preferred option, then you're more likely to be able to achieve that. So if you want to walk away from your business at sale, and you haven't taken the time to make sure that you have a strong, for example, board in place, if you haven't taken the time to review your processes and procedures, then it's going to be much more difficult for you to walk away in the way that you desire. Timing of planning as well. Again, Billy quite rightly mentioned that actually, whilst you do want to involve the accountants, the lawyers, the bankers reasonably early, they're probably not quite the first people that you want to speak to. And again, I would urge people to speak to your family and talk to them about what their expectations are. Partners and spouses will no doubt have strong views. Children will have strong views, particularly family members who are involved in the business. They'll obviously have very strong views as well. Of course, involve the accountants, the lawyers, when it's appropriate. I think for a lot of owner managers as well, their finances are entwined with their businesses. And so from a banking perspective, you need to consider how you disentangle yourself from the business and the timing for that. Do you need to extract cash from the business? Do you need to do that before sale? Do you have treasury? Do you have personal treasury, foreign exchange requirements? So sometimes we come across clients who, for example, have properties overseas, and they use their business to kind of affect some of their foreign currency needs, maybe their treasury needs. They hold big chunks of cash in the company because they haven't come up with ways of getting that out. So those are things that you need to plan for well in advance of a business exit. Get this area cleaned up in early course. Yeah, speak to the bank. Review in terms of the company's bank accounts. The bank, of course, will be interested as you approach exit. Speak to them. Don't spring surprises on them. They will have, again, a keen interest in this. I'm not a corporate banker, but I do know that I've seen in the past corporate banks insisting, for example, in a change of finance director in the run-up to an exit, or for other reasons, for example, where a company has grown from just being a local enterprise up to being something more like a national enterprise. So don't neglect that relationship. Engage with them when it is appropriate to do so. Talking of the finance director relationship, also when you're planning for exit, your relationship, if you're the CEO, if you're the chairman, if you're the manager owner of a business, it's likely that your relationship with the finance director is a key relationship. And this has sometimes some unforeseen circumstances. So bear that in mind. What is your relationship with your finance director? What is your relationship with the finance director going to be post-exit? Might seem like an obvious thing, and you might say, well, that will cease. Frequently, it doesn't cease, and it causes problems. So if the finance director, after exit, is on the phone to you every week or two, looking for your insight into how to run the business, then that can be highly problematic for a new owner, or if you have passed the business on to your children, that can be highly problematic. So bear that in mind. To the extent that some purchasers, trade purchasers and private equity and so on, they will often insist that a new finance director is put in place. So just bear that in mind. I've come across that on a number of occasions. Roles and controls. These two go hand in hand. Again, this is preparation for exit, and I touched on this earlier. I've seen a number of cases where a business owner gets an offer for, say, a trade sale, and they go through the process of due diligence, they go through the negotiation, and they go through what is, to be frank, a pretty unpleasant process. If anyone's been through the process of selling a business before, it can be really actually quite unpleasant, with long hours and difficult negotiations. So they go through that process, and after that, actually sale falls through. And they say, I've had people in that position say to me, do you know what, actually it's been quite a useful process, because I've been able to go through the business and review if I've got the right people in the right place, and I've been able to review our processes and procedures to make them more robust. That's perhaps something that would be better done in advance of the buyer approaching you. In some cases, I think that is sometimes a way of saying the sale fell through, because our processes weren't robust enough, and we didn't quite have the right people in the right place before we entered that negotiation period. In terms of controls, I think that the most successful businesses I've seen are those where senior management doesn't need to get involved too much operationally, too much in the day-to-day running, and can concentrate on strategy and leadership. A silver lining to having a business set up in that way is that it also makes succession a lot easier. If you are someone who wants to radically reduce your involvement with the business at exit, then the fact that the business is well set and has controls to ensure that it runs well in your absence, then that is more easily achieved. Next slide, please. As much as preparing the business is important, preparing yourself is very, very important as well, as equally important. And this is to a large extent the emotional factors that we touched on earlier. L'État, c'est moi. So Clanworth Ambrose is owned by a French bank, so I'm obliged, I'm afraid, to squeeze some sort of French phrase into most presentations. L'État, c'est moi. The state is me. So this is something that actually a lot of business owners have as well. They are the business, and the business is them. So a lot of business owners will define themselves, will get some of their status, will get some of their self-image from the business they own. If you're selling a business, if you're exiting a business, that will change, and that can have an emotional impact. So bear that in mind. Also bear in mind some of the maybe unforeseen factors from exiting the business. Again, I've seen business owners who for 20 or 30 years have had, to a large extent, their life organised for them by a very capable PA. And then they've exited the business and that resource is removed from them. And so I've had cases where people have struggled to, for example, book flights because their PA has booked all flights for them, not just business but personal. They've struggled to make restaurant bookings, organise their day, because, as I say, in the past, that has all been done for them. So there can be little unforeseen factors like that. And again, just to reiterate, ensure your personal finances are well separated from the business at that point as well, because in owner-managed businesses, sometimes those lines are blurred. In economics, there's a concept of land, labour and capital. So in economics, some people consider these are the only three things that you can make money from: land, labour and capital. If you're an owner-manager, your labour and your capital are both involved in the business. They are the things that make your business successful. Sometimes land as well. If you're a property developer, maybe land will be in there as well. But your labour and capital will certainly be involved. When you exit a business, you have a decision about how you deploy those things. So suddenly those things may become separate. So you might actually be able to generate sufficient income just from your capital. You might be able to generate sufficient income just from your labour. So you might decide to take non-exec roles, for example, to generate income. You might simply decide to invest your capital in, for example, discretionary investment management, and that will produce an income for you. You don't necessarily need to look around for opportunities to invest both your labour and capital. So it's a cliche that entrepreneurs find it difficult to move away from being entrepreneurs. And clearly entrepreneurs will have lots of skills there. They will be able to make money by combining their labour and capital into a new venture, but they don't have to do that. It's okay if you just want to retire. It's okay if you want to take different types of role that don't involve your capital. Don't feel compelled that you have to continue as an entrepreneur. Those choices open up to you. Sudden wealth syndrome is the next thing we're going to talk about, and seller's remorse. Sudden wealth syndrome is actually a recognised psychological condition. And I'm just going to read the definition of sudden wealth syndrome to you, if that's okay. Sudden wealth syndrome is a type of distress that afflicts individuals who suddenly come into large sums of money. Becoming suddenly wealthy can cause people to make decisions they might not have otherwise made. Sudden wealth syndrome symptoms include feeling isolated from former friends, feeling guilty about your good fortune, and extreme fear of losing your money. This syndrome can cause depression, anxiety disorders, and insomnia, and causes are things like sudden lottery winnings, large inheritances, gambling winnings, and business sales. Now, exiting a business and coming into a large sum of money is probably a first world problem. You won't get that much sympathy from your friends, but there are definitely psychological impacts, and you need to be aware that these can affect people who exit businesses in surprisingly serious ways, and ways that they have not prepared themselves for. So do give thought to what your life will look like post-exit and what you want it to look like post-exit. That really principally is what you're planning for. Finally, the splurge is maybe a slightly light-hearted aspect, a sort of a warning. So some people would say, just don't splurge. You know, you've made your money, you've made your capital, protect it ferociously. Every penny is a prisoner. I'm not sure I subscribe to that. I would say that it's absolutely acceptable if you sell a business and come into a life-changing amount of money. I say it's absolutely acceptable to splurge. However, it's extremely important that you set a limit to that splurge. Set a pounds and pence limit. Make a list of the things that you have on your wish list, but set a limit to them. So if you come into a great big sum of money and you want to buy a Ferrari, that's probably okay. That's probably okay if you've come into a sum of money that justifies that. And what I would say is, don't buy 3 Ferraris, which I've seen happen. Don't find yourself in a position where actually you become what you think is a really good friend of the guy at the Ferrari dealership, and you're turning over your Ferraris every 6 months. Don't do that. So do splurge, but do set firm limits to how much you want to splurge, and have specific things in mind. Don't let that drift. Don't let that drift, because that can be very, very damaging to your post-exit wealth. Past that, I would think about very, very simply, as I mentioned, it's kind of a technical exercise, but do think very, very simply when you're planning as well about what I call buckets. So you might want to have particular pots of capital for particular things. So you'll probably want a pot of capital, for example, to generate income. That's a common requirement, a common aim. You might also want to have a bucket of capital for your legacy, whatever that may be. So that may be for charity, or it may be some sort of structure to look after your family, your children, your grandchildren. So yes. So do bear those in mind. Do splurge. Don't hold back, but do set a limit. Thank you very much. I'd like to pass across now to Jeff Tressman of Punter Southall.
Thank you very much, Gareth. My name is Jeff Tressman. I'm a director of Punter Southall Wealth, and it's a real pleasure to speak to you all today. I echo the words of Roddy at the beginning that some of the things I may say now will be out of date by within the hour. So we'll have to see what the Chancellor says. Of course, you've got your own preoccupations at the moment with Nicola in the dock. That will be fascinating as well to see how that transpires. But what I've been hearing over the last hour or so, as you guys have, is that you may have thought building your business was a complex and lengthy process, but it's got nothing on trying to sell it or walk away from it by the sound of it. So 2 key things that have come out so far is planning and advice. And I would certainly echo that in the experience that I've had in dealing with entrepreneurs. I've had my own issues as well, experiences, as it were, of selling a company. I think probably it can be encapsulated very well by saying that succession is not an event. It should never be treated as an event. It is a process, and a process that should start as soon as possible. Now, I'm specifically, can I have the next slide, please? I'm cognizant of time, so I'm going to not dwell on any particular factor too long, but obviously very happy to take questions in the Q&A later. Just look at the financial aspects now of exiting a business. It obviously does depend on which route you're following. If you're selling the business, there's certain financial considerations there that in some ways differ from gifting or passing the business to family members or employees. So just looking down the list here, pensions funding, I've come across this situation several times where people have said to me, their business is their pension. And it's not uncommon to find people in their 50s that have done very little about pension planning. They've got little or nothing in their pots. And what's interesting is that a lot of the emotion is that it's too late to do anything about it. Well, there are specific rules regarding pension contributions that actually enable you to catch up pretty quickly. And in fact, by coincidence, I'm advising an individual at the moment who's selling a timber company, who's done very little planning. He and his wife are directors of the company. And he's probably 4 or 5 years away from walking away from the business. And his children are not interested in it. I've shown him a way of actually being able to accumulate nearly £1 million over a 5-year period, using the allowances which are restricted on pension funding. Why is it important? Well, he and his wife have very little pension benefits. They can accumulate going back 3 years using carry forward rules and immediately put in a lump sum of 320,000, subject to the company's finances allowing. They can then use the annual allowance going forward over the next 5 years and put £80,000 split between them. That, with a 5 or 6% net growth, will produce near enough £1 million after 5 or 6 years. Each of it shared between 2 spouses who are able to access 25% of that fund as a tax-free lump sum and draw income from the balance taxed at their marginal rates. So it's a hugely tax-efficient vehicle, but the tax advantages of pensions doesn't stop there. You have tax-free growth on the funds. So there's no income tax to pay on dividends or interest, or if the property, if the pension fund owns property, there's no tax on the rental income. At retirement, you're allowed to take 25% of the fund value as a tax-free lump sum. What's left is largely tax relief, funnily enough. But the greatest tax advantage currently is that whatever's left in that pension pot falls outside of your estate for inheritance tax purposes. It doesn't form part of your will. It's left to your beneficiaries via a letter of wishes at the trustee's discretion. So 3 major tax advantages, the like of which are not available with any other asset that you own. And that is why there's rumor that the restrictions on pension planning are going to be tightened even further later on today. At the moment, you are only allowed to accumulate pensions up to a value of just over £1 million. You're only allowed to pay £40,000 of pension contributions, be they company or personal. And those restrictions are indicative of the major tax advantages. So it is vital, even if you've left it late, that you plan as far as possible to fulfill those pension contributions. Before I leave pension contributions, we've already talked about the importance of wills. I've just mentioned that pension funds can't be put into a will because they're not subject to an individual's estate. But what is important is to look at the nominated beneficiaries and make sure that those beneficiaries are suitable. Clearly, in the majority of cases, it is entirely appropriate that the pension fund that an individual has accumulated is left to the spouse. It can be left to anybody. There doesn't need to be a legal relationship between the 2 of you. But very often, individuals, you may be amongst them, are going to be selling a company, a corporate entity, that's going to throw up more than sufficient funds for you to pass on to your spouse in the event of your death. So therefore, is it appropriate not to include your spouse at this stage, but maybe the children or maybe the grandchildren. It is an entirely flexible vehicle and needs advice. On the route to retirement, exiting, you need to ensure that during this accumulation phase, be it investments, pensions, or the most important asset, your business, that it is protected in the event of your death, in the event of diagnosis of a critical illness, in the event of some event that actually prevents you from fulfilling your role as entrepreneurs. Protection is vital. Roddy mentioned earlier about shareholder and business protection, key person. Shareholder and protection, partnership protection is vital. So very complex area, very important to get advice on that. Talking about trusts is important. It's the law in England and Wales is different to Scotland in certain cases, particularly in terms of jargon. There are a number of different trusts available. It goes without saying, really, it's vital you get advice on what trust to put in place. And as Roddy mentioned, it's not just for the rich. There can be a very important place for trust, both in terms of succession and gifting to children and grandchildren. Gifts to children and grandchildren, I think, can be incorporated here with the IHT issues on the last point on the slide. Inheritance tax is likely to be under review. It was going to form a very important part of a Labour government if we had got that. They were looking at replacing inheritance tax with a lifetime gift tax. The thought of a Conservative government bringing that in would have been ridiculous just a few years ago, but it still might be brought in at some point. Inheritance tax, as you know, is a hugely unpopular tax. And the greatest IHT avoidance, or sorry, planning, is outright gifts. You have to survive the 7 years. Taper relief is available, but outright gifting is the most suitable way of avoiding inheritance tax. Gifting to children, grandchildren, is a vital source of a very important way of passing down assets. Gifts out of regular income can be up to any amount, providing it doesn't in any way affect your own personal quality of life. Gifting shares in the business, again, can be done on a regular basis. You have to be cognizant of your own position in that business. Gifting too much may impact on your ability to make decisions on your own. Business relief, formerly known as business property relief, many of your businesses will qualify for that. It is a very significant advantage. Again, it's constantly under review. This may not be available in years to come. Any gifts that you make, particularly outright gifts, will be subject to inheritance tax if you die within the 7 years. That can be protected. You can take out a life assurance policy that is geared, the sum assured, the amount payable in the event of death, is geared to the liability that is a gradually reducing element over a 7-year period. Without getting too technical, if you die within 3 years, 100% of that gift is brought back into the estate, and it drops, the liability drops by 20% in each of the next 5 years to 0. So in terms of the tax consequences of succession planning, I can't stress enough that you cannot leave it until the last minute. It is a process that needs to be started literally as soon as possible. I think that really is just highlighting all the issues. As I say, I'm cognizant of time and the Q&A that's coming up. Very happy to take questions on any of the aspects I've very briefly mentioned. But that's all from me. Over back to Roddy.
Thank you. Thank you all for those talks. Please do use the chat function if you have any questions. Obviously, being prepared people, we've got a few questions already, which we prepared in advance, but if others would like to do so, please don't hesitate to use the chat function. I suppose actually the additional panel member I would like to introduce is Tim Wishart from Punter Southall Wealth, who is also going to be here to answer questions. And really, I'm probably going to open with Tim just to give him a chance to have a chat. And really, it's a question about how you work together, because it's, Tim, what are the benefits of working both integrated financial planning and investment management together, rather than considering them in isolation? And you might want to sort of double head this with Jeff as well.
Thank you, Roddy. It's very important to have a joined up plan. I am obviously an investment expert and Jeff is a planning expert. We can't profess to be experts at both. So if Jeff puts a plan in place for one of our clients, it's very important for him to know and understand that that plan will actually be met. So we need to have a joint philosophy, in particular if he agrees with his clients what sort of risk they might want to take, and indeed what sort of returns they might want, or alternatively whether they have a preference for income over growth. All of those plans have to be agreed with the client at outset, but more importantly, if you want to meet those expectations, you have to have a considered and joined up plan to do that. So at Punter Southall Wealth, in particular, we target inflation plus returns. That I think is especially important because it gives you some sort of guidance as to what sort of returns you might expect. And obviously, Jeff and I work together to make sure that investment process meets those returns. You don't take any more risk than you have to in order to get those returns. In particular, I'd say that typical clients of ours are people who have made their money, and they're probably got to that stage, as we've been discussing today, where maybe they're exiting a business. So they've made their money, they're unlikely to make it again. So they have to make sure that it is well protected, but also meets their expectations going forward. So that joined up plan is incredibly important. If a financial planner just put it together in isolation, how would you know whether whoever was appointed to run that money was going to do it on the basis of their plan? Jeff, have you got something you might want to add to that?
I think probably from my perspective, when I talk to clients, particularly those clients who have got what a financial advisor that professes to do both, I am not in a position, and never have been, to sit in front of a screen and monitor markets constantly and make adjustments to an individual's portfolio. I can advise on the portfolio, I can advise on the risk, etc., and I can put that all into a general financial plan. But what I cannot do is say that X fund manager is better than Y fund manager, or that stock is better than this stock, or whether that stock has now made sufficient profit for me to take profit and go somewhere and look for other opportunities. That is a constant proactive investment approach that can only really be done by someone specializing in investment management. It is an incredibly complex aspect that a financial advisor really cannot profess to have. So the skill set that I have is the technical aspects on the structures into which clients put money. And what Tim does is take that money and apply his skill set to constructing the asset allocation and the risk profile appropriate to the client. It's knowing really horses for courses more than anything else.
Thank you both for that. There's another question just come up, which is in terms of investing in business, how much is sustainability affecting choices? Now, initially, I thought this was for Tim and Jeff, and then realized that actually it's more of just how you're actually looking at investing in your own business. I'm probably going to pass this on to Billy, if you wouldn't mind having a look at this, and possibly Gareth making some comments as well. I think there is an element of this that it does depend on what the choices for the business are, what the choices for the individuals are, and also what their plans for the future are, because some businesses are relatively short term, some businesses are medium to longer term, and I think there is an element of what the individual's plans are. But Billy, if you could lead off, and then if we could transfer it on to Gareth from your experience, just in terms of looking at how people invest within their businesses. Thanks.
Yeah, thanks, Roddy. I'll make a start on this one. I think perhaps one of the main things you've mentioned there, sustainability, Susan, and how does that affect choices? if you speak to, I speak to quite a lot of angel investors and investment companies, and one of their concerns about sustainability is in an owner-managed business is how secure, believe it or not, it's an incredibly important question. One of their main questions is how strong is their succession plan, would you believe, right? So investors actually are well tuned in to asking that sort of question. How good is the succession plan? Does it have a dynamic behind it that will make it sustainable? The other interesting factor that comes up many times is sustainability is very closely linked to management, the performance management capabilities of the company. So when you're thinking of investing in business, then this sustainability thing is huge. So there's two things going on here that I would certainly point to. One is, what is the future aspiration for that business in its own marketplace? Not so much an in-depth market analysis, but how sustainable is it? Have they been adapting to market trends? Have they been mindful of them? Have they been taking them into account? And how much has that been part of the performance management of that company? And then again, you would look at the succession structure. Is it as strong as it was when, say, for example, it was the founders, or is it even stronger perhaps? I mean, we can't make the assumption that the succession takes us into a weaker environment. It could actually take us into a stronger one, but it nevertheless would be an important question. So I would be looking at those. Yes, those two things would definitely point to where sustainability would affect choices for investors, definitely. And that would be inward investment of family members or external investment as well, I would say, yeah.
Yeah, absolutely. I think we look at sustainability now, factors like the environment, social aspects, governance, and so on. These factors in business, I think, have moved in the past, say, 20 years from being a kind of nice to have things. They're more and more becoming a business imperative. So it's not just about saving the rainforests and being nice to animals, as it might have been viewed by cynics in the past. It's now a business imperative. If you don't properly consider ESG factors, then you will find it more difficult to exit. You'll find it more difficult to obtain funding as a business, because, for example, many private equity funds will now give consideration to what your ESG policy is. So it is, as a business now, just becoming a kind of a hygiene factor. You just have to have these sorts of policies, and if you're a mid-sized business and you don't have that, then you really need to act on it pretty quickly. In terms of ESG for private individuals, this is now again becoming a very hot topic. So again, in the investment world, it's moved from being a slightly fringe consideration, and it's now starting to become mainstream. So most investment management houses and firms will now offer what might be called green investment strategies, or investment strategies which give a lot of consideration to ESG factors. Climate Ambrose certainly offers a number of ESG strategies. The final thing I'd say about that is that responsible investing, ESG investing, is a highly personal matter, and so it's sometimes quite difficult for an investment manager, to be able to come up with say 3 strategies which are suitable for everyone's ethical considerations. So as an example of that, I was speaking to a potential client a few years ago, and we were talking about transitioning their portfolios with a different investment manager, and they were talking about bringing it to us, and we would transition it to a more green portfolio. So I had looked through the holdings. BP, okay, so BP, what do you think about that? Oh no, I think they're a polluting company, so I'd want to divest of them. Right, okay, that can be accommodated. Rolls-Royce, they're an arms manufacturer. Would you want to divest that? oh no, I happen to know that they're doing a lot of stuff on the corporate governance side. I happen to know about a lot of projects that they're involved in Africa. So actually, I'm really happy with them from an ESG perspective. So actually, that can sometimes be a highly personal judgment. But yeah, fundamentally, really, really important now. If your business doesn't have an ESG policy, something to look at really, really pretty urgently.
Sorry, thank you very much for that. I keep forgetting to unmute myself. Given that we actually have only about 2 minutes left, I'm not proposing to ask any more questions, and I think we'll just close the session a couple of minutes early, because otherwise I think we might run on, and I'm conscious of ECC's timings on this. I'd like to thank all the speakers. Thank you all, and also all of you for attending, and I'll now pass it back to Edinburgh Chamber. Thank you very much indeed.
Thank you, Roddy. So yes, just to reiterate what Roddy said there, thank you so much, Roddy, Jeff, Gareth and Billy, for your presentation today. I think it really helped to give clarity on succession planning, and when businesses and individuals invest so much of themselves and their time and their money into a business, it really gives peace of mind to know that it is all in hand when it comes to handing over. Thank you again to our sponsor of the session, Wright Johnson Mackenzie, who without this session would not have been possible. And a particular and personal thank you to the Wright Johnson Mackenzie team who helped to pull today's event together. Lastly, thank you to all of you for attending today's session. I know your time is very valuable, so thank you for investing it in us. We hope to see you again at some more of the events as part of Edinburgh's Business Festival, and wish you a lovely rest of your Wednesday. Thank you very much.